Hello to you all and welcome to another exciting video in the series of Margin of Safety Investing. In the last video, we discussed the 3 secrets to successful stock market investing. Those 3 secrets were: 1. Identify high-performing companies. 2. Give your investments time to perform. Please be patient. And 3. The high-performing companies need to be bought at reasonable valuations or deep discounts. We have already discussed the first 2 secrets in my last 2 videos. Today, we will be concentrating on the 3rd secret in today's video, which is buying great companies at deep discounts. So once you've selected great companies based on high return on capital employed formula, then also look for great valuations or deep discounts. I recommend using the historical valuation method to just speed up the process. You see, once you select high return on capital employed companies in your portfolio, which are also available at great discounts, your probability of winning drastically increases. Let's say if we buy 20 to 30 companies in a portfolio based on this methodology, then the number of shares in profit are going to be much higher than the number of shares which have made losses. This is obviously very probabilistic. But mind you, share market is a game of probability. We need to take calculated risks. And why do you think the probability is going to be in our favor in this case? If you remember, in the last video, we discussed the 2 qualities of high return on capital employed stocks. 1, the business model of these companies is highly resilient. And 2, the management of this company has a proven track record of creating a turnaround every time the company falls in trouble. So the probability of a bounce back in the valuations of such companies is always going to remain high. And on a portfolio level, you will see that the winners shall be always more than the losers. From a valuation perspective, always compare the trailing 12 months metric of valuation to the historical 3 years, 5 years, or 10 years valuation metric. This will give you a perfect relative historical valuation. You will ask, why can't we compare the valuations with other peer companies? But in my opinion, it is very difficult to find perfectly comparative stocks or peers. Always remember that the long-term historical averages of the valuation metric will always help you identify a broad range of the valuation. This will also ensure that you don't go too wrong with your valuation range. By using this method, you will be able to beat the benchmarks like Nifty or Sensex by a huge margin. I have been able to generate a 26% CAGR for the last 7 years using this methodology and idea. I have backtested formulas based on this particular methodology for the last 30 years. And trust me, it has given great returns. In my upcoming videos and webinars, I will be talking a little more about this particular methodology and how, with a little more detailing and a little more screeners and formulas, you can generate a very high return on a consistent basis from the stock markets. If you have been liking my content, then please subscribe to my channel so that you may get the notifications of the upcoming videos which I will be sharing with you.